Good afternoon. My name is Dante Shackelford. I'm the managing director at Financing Growth, and we specialize in financing investment property. That's everything from single family rental loans to fix and flip loans. We also do some multifamily and a little bit of construction, new construction, and commercial financing as well. I wanted to put this tool together for some of our clients who, in this challenging marketplace, they have to be a little bit more diligent in terms of their analytics in identifying deals. And so everyone should have their due diligence process for how you go about identifying properties. What I find is a lot of our clients are overlooking good deals because they haven't made a good process for comparing deals. And when we speak of comparing deals from an investment standpoint, we're not just simply looking at, aesthetics and neighborhood and the location that you're familiar with, but more importantly, the risk adjusted returns. And so that's what we're going to talk about today. And we're going to go through our most recent tool that we'll be sharing with our clients. It's called the Deal Track Quick Underwrite tool. And so we'll be going through doing some investment property comparison, pretty much just on the fly. And I think showing you guys a real live property quick underwrite is probably the best way to learn how to use the tool. So that's what we'll do in this video. And feel free to share it. Feel free to reach out to me directly if you have any questions, anything that we didn't cover. I'll try to keep it short. And again, the purpose of the tool is a quick analyzer. It's not a full underwrite. You can certainly get much, much, much deeper than what's in this particular tool, but I think it's more than enough to give you a good comparison of what opportunities are in your marketplace. So with that being said, let's go over to Zillow. And I did a quick search just for some multifamily units in the Grand Rapids, Michigan area. And I'm just gonna kind of go through and pick a property and see if it pencils out. Let's see here. I'll go with this one here. All right. Okay. Looks like we got a semi-renovated 2-unit northwest side. Asking price is $239. Being from Grand Rapids, I'll tell you, a lot of people would look at that asking price and just walk away. But there is a reason. This is a very popular up and coming side of town here, and it is close to a university. Let's see if the numbers pencil out. So going over to the analyzer tool, I'm going to leave some of the investment description information blank for right now. And if I like this stuff, if I like the returns, then I'll go back and fill that in. Okay. So if I remember correctly, it was all right. So we got 239.9 asking price. Everything in blue is an input sale. Everything in black is output and hard coded. So let's go write down some of our assumptions because this is the first box we're going to begin with. We're not going to worry about the cap rate for year one. That's going to be automatically calculated based on the purchase price and the net operating income. So reserves and working capital, it's always best to keep that at about 6 months. This is the cash that you're estimating to have on hand at closing. So after down payment, after closing costs, sometimes it's a requirement. If you're using financing, a lender may require you to have 6 months reserves. that calculation could be different from lender to lender. So a good estimate, I would say, is using the 6 month figure, but you can alter that, you can change that. You don't have to write the wording, just change the number. So if you want to switch it over to 2 months, or if you want to bump it up to 8, just type in 8. I'll leave it at 6. I'll leave the holding period at 5. Regardless of how long you actually intend on holding the property, generally set your holding period to either 5 or 10. It gives you a good comparison from property to property, but also any time period beyond 10 years, your assumptions are pretty weak because it's hard to see. It's hard enough to know the future 5 years from now. So to know the future 20 years from now, it's pretty difficult, if not impossible. For now, I'll keep the cap rate for exit at 8%, and we can go back and we can adjust that. We'll keep the sales cost at 6%, and for closing costs, we can do this one of two ways. We can set it as a percentage, 5 or 6%. I usually keep it at about 5%. Now, this figure here, you see how the box turned red? It's because this dollar amount is more than the 5%. So what that's telling me is maybe I should go in and I can click this the plus symbol here to expand it. And let's see if we can figure out whether or not some of the actual line items are off or could be adjusted. Everything pretty much seems in line here. We don't have property taxes or insurance in yet, and we'll put that down below. So for right now, I'll go ahead and minimize that, and I'll just keep that as is. We'll keep the growth rate for revenues at 4. We'll keep the growth rate for expenses at 3. Okay, so let's go back to the listing and learn a little bit more about this property here. All right, so we got a 2-unit. Unit mix is 3-bed, 1-bath at 1,000 and 2-bed, 1 at 950. The agent is saying that both units are below market. Okay, and it says tenants are responsible for all the utilities, gas. Okay, cool. All right, so what we want to do is we want to do two things. We want to get it as is. The economic picture as is, and then we also want to kind of have an idea as to what we can improve in a snapshot. So again, we're not going to go too deep into it, but let's put 1 2-bed, 1-bath, and I think it was what was it? 3-bed, 1-bath. All right. So all we have to do here is expand it. Hit the plus symbol again. There's 3-bed, 2-bath. Didn't include a 1-bath, so I'll go ahead and add it here. Anything in the yellow and the green, yellow sections and green text, you can edit. So we've got 1 unit for that. Total square footage is almost 2,100. Zillow doesn't break down the square feet by unit, so we'll just guess for right now. So I'll put box. There we go. All right. So currently collecting $950 for the 2-bed, 1 and $1,000 for the 3-1. Now, he's saying in the listing that the property is under market rent. We don't want to just, guesstimate without any support when we're looking at market rents. I like a website called Rent-A-Meter. You may have some other platforms or sources that you use, that's fine. But built right into the tool is the link to the Rent-A-Meter. So just go ahead and hit that icon and let's put in the address. So I'm gonna come over here, copy and paste. Come back over. I'm not going to select the rent. 2 bedrooms and bath. And we'll keep it within a relatively small radius. So we'll say 2 miles. If it doesn't bring back enough information, then we'll expand it. Okay. Okay. So it looks like the agent was he was telling the truth. So the average for the 2-1 in that area within the 2-mile radius is about 1136. Let's drop that into the model here. So market rent 1136 for the 2-1. Let's go back and see what it would be for the 3-1. Okay, 1387. So it is pretty significant. I found that the rent comps on Renometer, they're not too far off from what I see in most appraisal reports. Premium count and the incremental premium amount. This is for, let's say it's a 4-unit. You only plan to put premium finishes in 2 of the units and you want to charge a little bit extra. That's where you would do that. So, you put 2 premium units and we're going to charge an additional $200 a month, assuming this is already a 4-unit, and that's how it will work out. But in this case, we're not going to do that. We're going to keep that blank. So I'll zero that out and zero that out. And we'll go ahead and I'll minimize that again so we can keep the screen a little bit easier to navigate. All right. So we've got overview and assumptions, basic information such as the purchase price, and we've estimated closing costs to a small degree. And now, we got the rent roll information, most important. So now we can, have our gross revenue calculating all throughout the spreadsheet. So let's do the debt assumption. I would generally start at 75% LTV. That's going to be the max nowadays. In some cases, you can get 80, but again, we're not getting exact on everything. We want this to be a quick pre-underwrite. Once you have a good feeling for the tool, a lot of these blue cells, they'll stay the same from property to property, and you probably won't even touch them anymore. So we'll keep the rate at 7.25, 30-year AM, 5-year interest only. All right. Over here, market demographics. This is worth an entirely separate video. I'll go over it just a little bit. Median income. Median income. You want it to be 1/3 of. You want your market rate to be 1/3 of the median household income or less. Okay, so the median household income this year, Grand Rapids is 51, and I believe in 2000 it was 47. We can see our growth rate here, but in this column, we want to make sure that it's not more than 30%. In the premises, real simple. When you go to rent the properties, you generally want to see income 3 times more than the rent, and so that's kind of what that does there for you. So if we were to drop it, let's say that particular area, the median household income was only 35. Well, it's going to turn red and alert you. Doesn't necessarily mean don't don't consider the property, but you definitely want to figure out why, and maybe even do a little closer digging into what's going on here. So I'll put that back at 51. Population growth is critical. Population growth is really a good indicator. I think a better indicator of property appreciation than your typical home appreciation statistics. Most home appreciation statistics in data, it doesn't factor in inflation, right? So once you back inflation out, oftentimes you won't see any appreciation. A better data source, in my opinion, is population. If you have population growth, then you generally have income and employment growth. And it's just a supply and demand situation where if you have declining population, chances that the property is going to appreciate in that situation is not likely. So over time, you do want to see, and I mean long-term population. So over the past 15 or 20 years, you want to see good population growth. If you hover over you see these red corners here. If you hover over those, it'll give you a little more information on each of these demographic metrics. So again, like I said, that's worth its own video. I won't spend too much time there, but it's a critical component of analyzing properties, in my opinion. So I wouldn't produce a tool like this without it. All right, so let's go over to the operating statement here. Loss to lease. Loss to lease is essentially how long do you estimate it'll take you to go from the current rent up to the market rent. And so it's only 2 units, so I put it at 1 year. If I change it to 2 years, it does have an impact on returns. It has an impact on everything. So, this is one of those things that, again, I'm glad that we're including it on even a quote unquote quick analysis, because a lot of this stuff it seems ultra detailed and finite, but it's not. It allows you to play around with different scenarios, and it shows you the impact of what you may have thought was just a small decision. It could have a larger impact than you would generally expect. So vacancy, always keep it at least 5%. I don't care if it's 100% occupied. I keep the vacancy at least 5%. Same thing with management. Even if you plan on self-managing, you always want the asset to be structured for an exit to either a self-managed investor or a passive investor. So if I'm doing an underwrite, pre-underwrite, I want to put that into my initial numbers. It doesn't have to be 10%, it could be 6%, or it could be even higher, it could be 15%. But whatever it is, I would include a property management fee. I would also include something for marketing. We'll throw in something for maintenance. These particular tenants are accustomed to paying for their own utilities, so we won't include that. Insurance, we'll call it $12.50. Property tax, you could guess, or we might get lucky. And let's see if it's listed on the Zillow listing. I don't necessarily trust Zillow for tax rates, but in this case, I'll go ahead and use it. All right, so we got 1678. We'll plop that in. Now I'm kind of making a mental note that that's most likely homestead tax, and it'll probably switch over once I acquire it as a commercial investor. So we've got the expense ratio at 28. That's about fine for 1 to 4 units. I'd say roughly 30%, maybe 35% expense ratio is usually what we see. For multifamily, it's a little higher. So for an apartment building, appraisers usually use somewhere between 37 to 43% for expense ratio. If you don't want to plug in all these numbers, I would suggest that you plug these numbers in regardless. But if you want to play around with different scenarios, then you can use that box to override. Okay. The reason that you still want to itemize these amounts is because I mentioned earlier with your closing costs, we'll expand that. It's pulling in your property tax and insurance escrow amounts from that itemized list. So if you leave it blank and only use the percentage method, you're not going to get an accurate reserve amount for closing costs. So I'd suggest that you do that. All right. So, but again, it's in the ballpark, so we'll leave that be. Reserves. These are operating reserves, different from working capital reserves that we were trying to calculate at closing. This is just ongoing. How many, um, uh, what percentage of sales do you want to set aside? So I'll keep it at 3%. All right, and over here, we don't have to input anything, but it does give you a good breakdown of what to expect in terms of the capital stack. So we've got a loan amount of 179, and we've got cash or equity that we ought to be prepared to put into the deal, 82,000. Now, this is not the come to close dollar amount; it's more, and it's important that I point out what's not included in your amount to come to close in most cases. This 10,000 for working capital, this estimate, that's generally something that you keep on hand. Oftentimes, some lenders do require interest reserve to be held by them, but sometimes they'll require that they see this amount, and you don't necessarily bring that to close. So that's another dollar amount that may not be a figure. But regardless, if you have to bring it to close or not, you should have about $82,000 cash between you and your partners in order to execute on this deal. Okay. All right. So with all that, we can view a couple things here. Slide over one too far, and we can actually see operating statement projections over the 5-year period, and we can see what happens. We can see what happens at exit. In this case, it's year 5. Okay, you can actually use that to put out statements to send partners if that's what you need. All right. So we can use that for that. Another thing I want to mention here is there's a neighborhood scout link already built into the tool. I use this a lot. I love Neighborhood Scout. You can get a ton of good information in these reports. These reports, they're not free. So you may be able to find some of the market demographic data for free. You have to go through a bunch of different sites, U.S. Census Bureau, Department of Numbers, a couple other places where you can find it for free. But if you want to save time and really get a snapshot of the neighborhood, as well as the city and the MSA, highly recommend using Neighborhood Scout. I think those reports are $29 per city, and I think there's a subscription model for maybe $49 a month. I could be wrong, but it's definitely worth it. All right. So now the fun part. Let's compare returns. All right, so once you come up top, you'll get a chance to look at your levered and unlevered returns. Levered meaning with debt, unlevered meaning without debt. Okay, so if you were to buy it all cash, this is what your returns would be. Okay, the two most important returns, in my opinion, would be IRR and equity multiple. And what I've done is I've color coded it to make it a little bit easier for you to identify something that's just not, it's not within the bracket of what we'd be looking for. So for levered returns, we don't want to see anything less than 10%. Between 10 and 15%, that would be okay, and anything greater than 15 would be good. For equity multiple essentially means, and here's an explanation of it right here. It's, how many times you get your cash back during the course of the investment, right? So 2 times is good. That's what we're targeting. We're targeting 2 time or greater multiple. Anything lower than that is okay. Under 1.5, I wouldn't even look at it. If you want to learn more about IRR and equity multiple, you go ahead and click these links here. It'll take you to some articles and videos that can help you get a better feel for what you're measuring with these metrics here.